Ladies and gentlemen, I want to talk to you about individual retirement plans, more products on the retirement side that complement the annuity, that will then hopefully complement possibly his 401k or her 403b plan, employee stock ownership, pension, and profit sharing plans that might be offered to the employer, to the employee by the employer. The regulations associated with individual retirement plans are quite extensive. We're dealing with a federal product now that has a lot of federal rules and regulations, and the first thing I want you to be aware of and never forget, in the opening and the maintenance Series 7 of IRA accounts, you will act in what is known as 7 Bullet 1, a custodial capacity, which means predominantly you're opening up this account for safekeeping, which means that there's not going to be a lot of trading in this account, either with your recommendations or clients, because you're dealing with retirement assets. Never forget that. That means that most of the investments are made on what is called a self-directed basis, directed by the client with your advice. And so you're kind of opening and maintaining that account, you know, on a custodial basis. And I wanted you to be aware of that. Now, when opening up an IRA, I want you to know that the contribution that the client gets to invest in the IRA has been increasing over the years. One of the problems that we've always had in this country is not the number of retirement plans that we could have. We could have many retirement investment vehicles. Are you with me so far? Yes. It's the amount of money we get to contribute. Now, I want to talk to you about a statistic that's really powerful and is above and beyond the 7. I want to talk to you about the third year of a presidential cycle of a reigning president. In the third year of a presidential term and administration, you'll always find that that president launches an economic policy domestically designed to win re-election. Dating back to the Truman administration, that's more than 50 years, this past president, George Bush, was no different. He launched what was called the George Bush Economic Boom Package, designed to revitalize the domestic economy, but predominantly to win re-election. If it wasn't for that package, he wouldn't have beat out Kerry, and Kerry would have been our president, or even so far in his second term. Because I will assure you that Bush didn't win because of international policy. Are you with me so far? Are you with me?
Yes.
And in that re-election, predicated on the launching of that domestic policy in the third year, if you look at the technical graphing of the performance of stock pricings in the market, dating back 50 years, you'll always see that in a third year of a reigning presidential cycle, that the market has always peaked and performed significantly bullish on that positive news because of that domestic policy that's been launched, designed to win re-election. So you can almost time your profits. Are you with me so far?
Yes.
Because it's pretty much a staple to the economy and the performance of stock pricing. And Bush said, you know, we have to allow people to put more money into their retirement plans because that's one of the significant restrictions that was hurting how much we would be able to put away for retirement. Are you with me so far?
Yes.
And from the years of 2002 to 2004, it was $3,000 if you filed an individual tax return, $6,000 if you filed a joint return. The years of 2005 to 2007, if you filed an individual tax return, your max contribution was $4,000. If you filed a joint tax return, it was $8,000. Series 7. In the years of 2008 and right now and then thereafter, filing an individual tax return, the maximum contribution is $5,000 individual, $10,000 if you filed a joint return. Are you with me so far?
Yes.
Take a look at the joint return tax filings right now. Look up. If it's $10,000 for the years of 2008 and above, $5,000 for the husband and $5,000 for the wife. What you need to be aware of is, whenever there is a joint tax return filed, are you with me so far?
Yes.
The contribution must be established by opening up 2 separate accounts. 7! One account for the wife and one account for the husband, where they would be putting in each $5,000 for a total contribution of $10,000. What that means is, what I'm trying to impress upon you is, you may not have a joint IRA. Are you with me so far? Yes. Monies may not be commingled. They must be segregated. There must be one account for the wife and a separate account for the husband whenever there is a joint contribution because of a joint filing of a tax return. Are you with me so far? 2 separate accounts. Cannot commingle the monies and open up one joint IRA and put in $10,000 into that joint IRA. It's 2 accounts, $5,000 for the wife and $5,000 for the husband. Are you with me so far?
Yes.
You may not liquidate money out of the IRA prior to the age of 59 and a half. without incurring. Bullet 1, a 10% penalty on the amount withdrawn. Watch these regulations, they are extensive. And bullet 2, look up. The amount withdrawn would then be added to earned income to adjust your gross earned income upward, to increase your tax liability on earned income, acting as a second deterrent to deter people from pulling money out of the IRA prior to retirement. Are you with me so far?
Yes.
Now, I want you to know that really may not pull money out of the IRA prior to retirement without incurring this penalty. Are you with me so far?
Yes.
But what about people just like me? People who are 53 years old, who are coming close to retirement by age. Are you with me so far?
Yes.
One of the problems and the disadvantages that I have that you don't have is I don't have much time on my side to establish a portfolio like you do to put money away into the retirement plan. Are you with me so far?
Yes.
I mean, I'm 5.5 years away from retirement, technically. It doesn't mean I won't work past retirement, but the bottom line is the IRS will allow people who are what are known as 50 years and older to try to catch up to people who are much younger and be eligible for what is called a catch-up provision. It allows people like me who are 50 years of age and older to put into that retirement plan just a little bit more than you can. Are you with me so far?
Yes.
In addition to my normal contributions of $5,000, are you with me so far? I would be able to put in an additional Series 7 $1,000, and that $1,000 is called a catch-up provision. So my total contribution would be $6,000. Are you with me so far?
Yes.
Because I am 50 years of age and older. So the catch-up provision is $1,000 additional, in addition to the normal contribution of $5,000 individual and $10,000 joint. So if my wife was also over 50, it would be $6,000 for me and $6,000 for her. Are you with me so far?
Yes.
For a total of $12,000. In any case, the catch-up provision is $1,000 for 50 years of age and older. Now, with respect to the penalties on the liquidation of money out of the IRA prior to the age of 59 and a half, and that money is then added to earned income. Are you with me so far?
Yes.
You can choose not to pull your money out of the IRA when you pass retirement. Are you with me so far?
Yes.
That penalty exists if you're pulling money out of the IRA prior to retirement. Are you with me so far?
Yes.
But the IRS has said, look, if by the age of 70 and a half, listen carefully, you have not pulled money out of your IRA account, according to what the IRS has established as what is called the individual's required minimum mandatory distribution, known as the RMD. The RMD is a schedule that the IRS puts out that says how much people are required at minimum to pull out of their IRA every year. You can choose not to pull this minimum required mandatory distribution out of the IRA prior to the age when you pass 59 and a half. You've been so far.
Yes.
But it's just that if by the age of 70 and a half you have not pulled money out of the IRA according to this required minimum mandatory distribution schedule that the IRS has set forth, well then the IRS Series 7 is going to hit people with a Series 7 a 50% penalty on that required minimum mandatory distribution, on that minimum that you are required to pull out. Are you with me so far? If you have not pulled out that money, according to that RMD schedule, by the age of 70 and a half. Now, why is that penalty so stiff? It's staggering. Are you with me so far? Why is that penalty so stiff? What is the IRS really worried about? Why do they care if that by the age of 70 and a half you have not pulled money out of the IRA according to this required minimum mandatory distribution? They're going to levy a 50% penalty on that RMD distribution schedule. What are they worried about? No.
Too much money?
No, sir. They're worried about death and deceased assets. Are you with me so far? And so that penalty is designed to induce you to ensure that at least by that age you started to pull money out of the IRA according to that RMD minimum schedule. Are you with me so far? Up until 70 and a half, you choose not to pull money out of the IRA account according to this minimum required mandatory distribution, which is taxed at OI. You with me so far? That's fine. But by the age of 70 and a half, the penalty is rather stiff. And so, if you decide to put more money into the IRA than this maximum allowable limits of 5,000 individual or 10,000 joint, you will incur 6% penalty on the excess contribution. Are you with me so far?
Yes.
So look at the ages, look at the dollar amounts of monies, look at the penalties, look at the contributions, and they're all consistent with NASDAQ. Al?
How could someone put in more than
They would. If they wanted to put in a considerable amount of money and willing to take on the penalty just to be able to finance and put more money for the retirement and take on that 6% penalty on the excess because they wanted to establish a significant portfolio, and they thought financially it's more favorable for them to establish a significant investment in the IRA while it's being earned in tax-free bonds, if you will, or other investments in collateralized mortgage obligations, and willing to pay on that penalty, they might choose to make that decision. That's correct. Otherwise, you would choose not to do that. Correct. Now, I have a client. Look up. Who is 42 years old. He earns $30,000 a year in earned income. He pulls $3,000 out of the IRA account for financial liquidity needs. Find this client's adjusted gross earned income. Those are your choices. 33.3, 30.30, 33, 33. Go!
C? No. No, this is a question. If I'm not right, I need to know why. D. D.
D's out. Look up. D is out.
Oh, A.
A is out. The answer is C. Because you don't listen to me. You think you listen, and you're headed for disaster if you don't listen to me now. What is the penalty? You're going to tell me it's 10%? I know that. I'm looking at numbers. The penalty is 10% of the amount withdrawn. The amount withdrawn is $3,000. Penalty is $300. Now, what's the second part of the regulation? And the amount withdrawn, which is $3,000, is added to earned income on 30. You're going to be taxed on 33. Are you with me so far?
Yes.
Are you with me so far?
Yes.
So now your tax liability is not on 30, it's on 33,000, and your penalty was $300. In the real world, you're not actually going to get the $3,000. You're going to get the proceeds of the amount withdrawn less the penalty amount by the IRS. Are you with me so far? They're going to send you a check for $2,700. You're going to be taxed on 33 grand. Are you with me so far? Yes. Watch your regulation. It's 10% on the amount withdrawn. The amount withdrawn is $3,000. Penalty is $300, and the amount withdrawn, $3,000, is added to the 30 earned income. You're taxed on 33, acting as a second deterrent. Are you with me so far? Yes. There are, however, exceptions to the liquidation of money out of the IRA prior to retirement. Thank you, George Bush. Thank you for these incentives. And this is part of a domestic policy that was launched, as we've talked about, designed to incentivize people. Are you with me so far? Yes. People have needed to tap into the IRA for liquidity needs for educational costs, to buy their first-time home. Are you with me so far? Yes. Or to pay for certain medical expenditures. And so the following are the liquidations of money out of the IRA prior to retirement without any penalty whatsoever. Series 7, Bullet 1, death. Series 7, Bullet 2, mental illness. Series 7, Bullet 3, pulling money out of the IRA to finance your first-time home, to realize what's truly today an American dream. Series 7, Bullet 4, for financing medical costs. In Series 7, Bullet 5, educational costs. These are the exceptions of liquidation of money out of the IRA prior to retirement without any penalty whatsoever, and one more exception to the rule. For the implementation of the execution Series 7 of the IRA 60-day one-year rollover. The IRA 60-day one-year rollover. Now read the next page, if you will, in the body of your work. Just look at me. If your client calls up at any age prior to retirement, are you listening to me?
Yes.
And says, sell it all! Liquidate all of the money out of the IRA. And if he then takes all of those proceeds, 100% of them, from the liquidation of money out of the IRA and rolls them over into another IRA within a 60-day period of time from the trade date of sale, and he can only do that once a year, you with me so far? Yes. There's no penalty whatsoever on the amount withdrawn. The liquidation of money out of the IRA into another IRA within a 60-day period of time, called the IRA 60-day one-year rollover. There are the exceptions to the rule of pulling money out of the IRA prior to retirement without any penalty whatsoever. Are you with me so far? Yes. Well, we established the regulations of the IRA, and they're significant. Are you with me?
Yes.
But now I want to talk to you about another product. Moving away from the IRAs now, we're going to the Keogh plans. A Keogh plan is a retirement investment vehicle. Are you with me so far?
Yes.
Where the only monies that will be contributing to the Keogh plan, 7, Bullet 1, is self-employed income exclusively, not earned income. Only self-employed income. Watch my regulation. They are extensive today. The maximum amount of money that can be contributed to a Keogh plan annually is 20% of 7 pre-tax income, or $40,000, whichever is the lesser of the two. Used to be $35,000. Bush increased it by $5,000. Now it's $40,000. 20% of, not post-tax income, pre-tax income, or $40,000, whichever is less. That's the maximum amount of money an individual can contribute into the Keogh plan annually. If an individual contributes more money into the Keogh plan than that maximum contribution annually, the individual will incur Series 7 a 6% penalty on the excess, just like the penalty on the excess put into the IRA. Are you with me so far?
Yes.
Do you understand the regulations of Keogh? Yes or no?
Yes.
Series 7, I'm going to give you 2 trades. Don't answer after the first. I'm going to NASDAQ. I'm talking Keogh. Are you with me?
Yes.
Mr. Johnson is the head of oncology surgery at Columbia, New York Presbyterian Hospital, earning $7 million a year in earned income. He would like to establish a Keogh plan and contribute no more than the maximum of 20% of pre-tax income or $40,000, whichever is less, of his $7 million in earned income. A, he may. B, he may not, because that is not self-employed. C, he may or may not. D, none. Don't answer. Second trade. Ike Rabinowitz is the managing partner of the law firm of Rabinowitz, Inc. International. He earns $15 million a year in charge of negligent law litigation and arbitration. He would like to establish a Keogh plan and contribute no more than Keogh's maximum contribution of his earned income of $15 million. Are you with me so far?
Yes.
Here's the problem on the 7. They're telling you the individual, they're giving you the name of his position or who he works for, and then they're telling you how much money he earns, and they're calling it earned income. Are you with me so far?
Yes.
You're looking at Keogh, you see earned income, and what would be the normal reaction? That they cannot touch any of this earned income according to that Keogh's maximum contribution, because that's not self-employed. Are you with me so far?
Yes.
And the question is unfair, because they know you don't know the IRS code. And by the nature of the position, Series 7 of a doctor or a lawyer, even though they're qualifying it as earned income, it is considered to be self-employed income, and it may be contributed into the Keogh plan according to that maximum contribution, and no more than. Are you with me so far? Series 7. Watch the 7, watch me, listen to me. Are you with me so far?
Yes.
Okay. So we got Keogh, we got IRA regulation, we know a little bit about the fixed and variable annuity, and the regulation continues to mount today. Are you with me so far?
Yes.
And now I want to go into the private sector. I don't want to talk about sponsored employer-employee plans. Corporations may offer their employees retirement plans. Are you with me so far?
Yes.
Now, the IRS has said, listen to corporations, if you want to offer a retirement plan to their employees, are you with me so far?
Yes.
Well, then that plan should be structured and designed and established and set forth according to the characteristics of ERISA. ERISA has set the standards and the qualifications that companies must meet in order to require that this plan conform to what is called a qualified retirement plan, according to the IRS Code of 1974. The IRS Code of 1974 has established ERISA. ERISA has established the characteristics and the criteria that companies must meet in order for the plan that's offered by the employer to the employer to be considered a qualified retirement plan. So now you might ask, well, what if the retirement plan that's offered by the employer to the employees does not conform to the characteristics of ERISA? Are you with me so far?
Yes.
Well, then that plan is a non-qualified retirement plan. And so now the greater question becomes, why is it so important for corporations to establish this retirement plan as a qualified retirement plan rather than a non-qualified retirement plan? Why are they working so hard? And they are, believe me when I tell you, as you're about to see why, to establish this retirement plan if they're offering to their employees as a qualified retirement plan according to the standards set forth by ERISA. Because only if it's a retirement plan that is known as a qualified retirement plan would the employer have an opportunity to take all of the money put into that plan for their employees, are you with me so far?
Yes.
And have that contribution, are you with me so far, transferred on a dollar-for-dollar basis as Series 7 Bullet 1 as a write-off against income. Otherwise, they wouldn't get the write-off. So, if you'll look at me for a moment, and I tell you now, we are now employees of the Chrysler Corporation. Thank you, Lee Iacocca. Thank you, Chrysler. We are factory workers. We work in Detroit. We work on the line. We build American cars. Lee wants to offer us a retirement plan so that when we retire from the Chrysler Corporation, we can go into an account and have some type of retirement portfolio for us. This is a great man. Are you with me so far?
Yes.
The IRS has said to Lee, listen, meet the standards set forth by ERISA on how you structure this plan, how you fund this plan, and then you'll get significant incentives. What if I told you that Lee Iacocca wants to take $30 million from their profits, from their net income, from their earnings, and put that money into a retirement plan for 450,000 factory workers nationwide? If this plan, as you're about to see, has met ERISA's criteria, then I am telling you that the $30 million that they put into that plan, are you with me so far,
Yes.
for 450,000 factory workers will then be able to be transferred onto the balance sheet of Chrysler to receive a $30 million tax deduction. All of the money contributed into the plan would represent on a dollar-for-dollar basis a deduction against income. They get a $30 million write-off. What else would the corporation receive if they're offering and establishing a qualified retirement plan besides the deduction of the contribution against income? The income that's being earned in that plan, that $30 million is invested in, are you going so far? Yeah. Series 7 Bullet 2 would be tax-free to the employer. They're not paying any tax liability on the income that's earned in the investment in the plan for their employees, for their retirement. Are you going so far? Yeah. And at the end of the tax year, listen to this, the employer that has established a qualified retirement plan would have the benefit of receiving investment tax credits, are you with me so far, 7 Bullet 3 investment tax credits, which are even further deductions against corporate income, which will allow the corporation to have a healthier balance sheet to become significantly much more profitable than if it was a non-qualified retirement plan. So for all of those three reasons financially, you can see why a corporation is working so hard to establish this retirement plan as a qualified retirement plan. Are you with me so far? Yes. And so what has ERISA said? That the corporation must establish and meet in order for the plan to be considered a qualified retirement plan according to ERISA, criteria number 1, Series 7. That this plan meet ERISA's first requirement is funding. Now, the plan may be only funded, according to ERISA, any one of two methods of financing. Series 7 Bullet 1 on funding. It can be funded based upon a defined benefit method of financing or a defined contributory method of financing. Break down the definition of funding, which is the first requirement of ERISA for NASDAQ. A defined benefit method of financing would require that the employer, in my example, Chrysler, established an actuarial study, which is a mathematical study that takes into consideration many economic variables, like the employee's age, seniority, income, position, many economic variables into this actuarial mathematical study that would then establish a certain dollar amount of money to put into that plan for their employees as one method of financing the plan. Are you with me so far? Yeah. Actuarially is defined benefit method of financing. The alternative method of financing, according to the criteria set forth by ERISA of funding, is a defined contributory method of financing. In a defined contributory method of financing the plan, according to ERISA, the employer would be required to take Series 7, Bullet 2 now, a percentage, the same percentage of the varying annual salaries of the employees. So just as an example, if they used 6% as the benchmark percentage, they would take 6% of the different and various annual salaries of the employees to come up with the dollar amount of money to fund the plan for the employees as the second and only second alternative method of financing eligible to ERISA. Are you with me so far? Yes. Make this plan qualified. Now, on funding. Which method of financing is going to allow the employer to put away more real, absolute dollars into the retirement plan for their employees? A plan that was financed based upon a defined benefit method of financing or defined contributory method of financing? Which one?
Defined contributory.
The answer is defined benefit. Thank you very much, Michael. It's okay. Take a look why. Look at me. Percentages are fixed and are eroded by inflation, which is a defined contributory method of financing. Look at me. Look at that actuarial study. Remember that I told you that that actuarial study takes into consideration many economic variables? One of those economic variables is the time value of money. And so therefore, any method of financing actuarially that takes into consideration the time value of money is going to have more money into the plan in real dollars indexed to inflation than a method that was financed and eroded by percentages. Are you with me so far? Yes. That's why a defined benefit method of finance will put away more real dollars for the employees in the plan by retirement than the method that was financed based upon percentages which are eroded by inflation. The second criteria, according to ERISA, to make this plan a qualified retirement plan to allow the employer the staggering tax deductions and incentives and write-offs across the board is vesting. You didn't really think that when the employees got to retire from the employer and they went into that plan to pull the money out of that plan for their retirement, they got to pull out all of the money that was in that plan, did you? No. The vesting provisions, Series 7 Bullet 2, according to ERISA, talk about the maximum amount of money that the employees can withdraw and no more than if it is a qualified retirement plan. The third criteria, according to ERISA, is participation. Whom must the employer have participate in the qualified retirement plan if they're offering one according to ERISA? Any employee who works for the employer? No. According to ERISA, the employee must be 7-bullet-1, at least 21 years of age and older, and work for the employer for at least 1 year of service or greater, and at the discretion to the employer, part-time workers may be excluded from participation of coverage. And finally, ERISA has said to the Chryslers of the world, if this plan is to be qualified, you must have some game plan on how the money is invested and managed and administered in this plan for your employees. 7, plan administration is the last criteria that a corporation must meet according to the Code of 74 of ERISA in order for this plan to be considered a qualified retirement plan. Are you with me so far? Yes. But the corporation may offer other plans to their employees besides qualified retirement plans. They could offer their employees Series 7 Bullet 1 a pension plan. If an employer is offering their employees a pension plan, it can be funded, the pension plan, either on a defined benefit or a defined contributory basis, actuarially or by taking a percentage of the annual salaries of the employees. Are you with me so far? Yes. Pension plans Series 7 Bullet 2 are not contingent upon corporate profitability. If they're offering a pension, they must provide the pension, whether they are profitable or not. But if the corporation is offering their employees a profit-sharing plan, that is an opportunity for the employees to share in the profits of the company. Therefore, that plan is contingent upon whether the company is profitable or not. Are you with me so far? Yes. Look up. A 401k plan is a similar and type of qualified retirement plan offered by the employer to the employees. The only difference between the 401k plan and the qualified retirement plan, according to ERISA, is that the 401k plan is structured as a trust, whereby there is the establishment Series 7 Bullet 1 of a trustee who is designed to administer a trust and the management of the assets in the 401k on behalf of the employees of the employer. Are you with me so far? Yes. Now, we've seen a lot of mismanagement of that trustee in the real private sector. And as a result of the Enron case, whereby the only money that was invested in the 401k plan was invested in the common stock of Enron. Are you with me so far? Yes. When that company went out of business because of the manipulation of energy on the internet, are you with me so far? Yes. And therefore, that stock went to zero value. All of the employees of Enron lost their entire life savings. Are you with me so far? Yes. Not by the time you take the Series 7 examination, but in the future, I think you're going to see a regulation called the 70% 401k concentration rule, prohibiting the employer from putting more than 70% of the assets of the employees of the employer into the common stock of the same issuer, to allow them the diversification in the management of those assets of the 401k plan, that should that company go out of business, like Enron, companies would then still be able to provide employees with some type of retirement investment. Are you with me so far? Yes. The 403B plan is similar to the 401k plan, operating and structured and designed as a trust basis, where there is a trustee designed to administer the assets on behalf of Series 7, the Teachers of America, and municipal employees. 403B plans, just like 401k. 401k is private sector. 403B plans are for municipal employees who work for the state and the Teachers of America. And finally, if a company is offering the employees an opportunity to participate in ESOP, that is employee stock ownership, there the employees would have an opportunity to have equity ownership in the company and on a piece of that company, employee stock ownership. So, qualified retirement plans, pension, profit sharing, 401k, 403b, and of course ESOP, regulations associated with KEO, IRAs, and fixed and variable annuities. This day continues. These regulations, believe me when I tell you, are staggering. Are you with me? Yes. Now, let's go to the addendum, shall we? I want to talk to you about some of the changes that are on the 7. And I want to walk you through this document. Let's pass that down all the way if we can, so that Priscilla can give it to our colleague in Al Pederoy, right behind her. Take a look at the first page, which gives us a breakdown of the addendum. First page is starting to talk about, in this document, some recent federal regulations, which I'll go over. Then they start talking about, in the next segment in the middle, some market updates. Some areas, again, as we've seen, and some we're about to see. And then they start going into product updates. So why don't we turn the page right now and break this document down. In page 1, the first of a battery of federal regulations, on page 1 only, please, ladies and gentlemen, so we can stay together on this, is Regulation SP. Have you ever applied for a credit card lately? Have you ever looked at the application that was sent to you in the mail from Citibank or even Shell, or any of the oil companies, or any credit card, there might be a loose document that flies right out of that envelope. And that document says on it ERISA. I don't know if you've ever seen this document. It also says something else. It says privacy notice. You know, when we open up client accounts at an investment bank and broker-dealer, we have access to a tremendous amount of client confidential information on his net worth, where he banks, his liquidity, his suitability. There's a whole financial profile there. This regulation says that that financial profile of client account information, which is confidential, must be protected. So what do you think we have to do? We have to send him out a privacy notice that his information of the confidentiality of his financial profile may not be sold, are you with me so far? Yes. And protected. Now the question becomes, which is the heart of the regulation SP, which is the federal regulation, SEC now, is the timing when we are required to send out that privacy notice. And the timing on when we send out the privacy notice is distinguished based upon whether the individual is, listen to me carefully, a client of Merrill Lynch or a consumer of Merrill Lynch. There's a difference between an individual who's a client of a broker-dealer and an individual who is a consumer of a broker-dealer. A client is a customer of the brokerage firm who's opened up an account. A consumer is not a client of Merrill Lynch, but rather an individual who has sent over information to Merrill Lynch regarding another party. Are you with me so far? Yes. And the distinguishing characteristics between a client of the broker-dealer and a consumer of broker-dealer determine when, the timing of when we send out that privacy notice, which is the key to the Federal Act. And looking at the regulations, it is the third paragraph down. Firms like the Merrill Lynches of the world and the Morgan Stanley Dean Witters of the world must furnish and send out to every consumer, are you with me so far, a privacy notice, Series 7, Bullet 1, when the relationship is first established, Series 7. And then, of course, send out that privacy notice annually to an individual who is a customer of the broker-dealer. This is an individual who is a customer. Are you with me so far? Yes. A client of Merrill Lynch. But the next paragraph talks about a consumer. The consumer is not a client of the broker-dealer, but has furnished the broker-dealer with information regarding another party. Are you with me so far? Yes. Whether we send the privacy notice out to a consumer of Merrill Lynch, firms must give every consumer a privacy notice, Series 7, Bullet 1, and I've isolated it and circled it for you, before Merrill Lynch discloses any non-public personal information to any non-affiliated third party. So there's a difference in the timing mechanism of when that privacy notice is sent out, correct? Yes. Of whether you are a client of the broker-dealer or a consumer of the broker-dealer. Now, in continuing with federal acts, in the addendum, we look at the Patriot Act. And you know that was an act that was designed to and established on the executive level to fight terrorism. Agreed? Yes. Here's what you don't know. What you don't know is it's on the Series 7 exam for the following reason. That's simply because it's a federal act. But we learned a lot of information about that terrorist attack in 2001 on September 11th, like the money that was used to finance that attack from Al-Qaeda, are you with me so far, was financed and invested in accounts owned by Al-Qaeda network at every brokerage firm or most brokerage firms in the United States. You didn't know that. Let me tell you what else that we've learned after the attack happened. Are you with me so far? They money laundered money through the brokerage industry. Are you with me so far? Yeah. They knew that once that attack was facilitated and implemented, that they would suspend and hopefully look to collapse the financial capital. Are you with me so far? That was an attack in the financial capital, not to discredit what happened in Washington. Are you with me so far in that other attack? But there were other plans, like a plan to go into the Pentagon. Are you with me so far? Cripple the country and shut down that exchange as a result of the attack. They tried to get a plan into the Federal Reserve, but based upon where the Fed is located, that was very difficult, so they went with the towers. There's a lot that we learned right now. Are you with me so far? Excuse me. That we didn't find out until after the fact. Well, they knew that they would cripple the economy. That was the hope. They knew certainly they would shut down the exchange. Are you with me so far? Yeah. And for the very first time in the history of 215 years of trading, as a result of that attack, the New York Stock Exchange was closed for how many days? Do you know? 1 week. And I can't tell you the effort that it took, approximately 1 week, the effort that it took to get that exchange open. Are you with me so far? Yeah. It was an effort that was beyond the call of duty. New York Stock Exchange is a federal exchange, acts just like any federal bank, can't close for more than 3 days in a row. Well, they knew that ultimately when that exchange would open, that they would blow American patriotism. Are you with me so far?
Yes.
And kind of break down our psychology of our passion for living in this country. And so therefore we also know that through the trading of the accounts that were owned by Al-Qaeda, they shorted a tremendous amount of stock on its depression, hopefully in crippling the exchange, and they made a tremendous amount of money laundering money through the broker-dealer industry. And that's why now we have work to do that we never had to do before. It's a new world, there's no question about it. And that is that we have to do a manual box count of all securities that are owned and identify the ownership of these accounts. The compliance officer and directors of your broker-dealers are required to run mandatory compliance programs to teach us how to detect suspicious trading activity and suspicious accounts. And those annual compliance meetings relative to the Patriot Act, relative to September 11th, are mandatory. Are so far?
Yes.
And so what you're about to start to see now are some of the regulations and the byproduct of the administration from the Patriot Acts designed to fight terrorism, all because of what happened on September 11th that has us at a new heightened level. Are you with me so far?
Yes.
First, you've always known that when you pull money out of an account that exceeds more than $10,000, they always gave you a form at the bank, or even when you cashed the chips in Atlantic City. You won 15 grand. Good luck. You had a good day on the casino floor. Oh, by the way, here's your money. Sign this form. What's this form? Well, you didn't know what the form was, but you knew it was something to do with the IRS, and that is Form 4789. Form 4789 is a form that has to be filled out when you are pulling more than $10,000 out of an account. Are you with me so far?
Yes.
It's called a currency transaction report. It has a number, it's 4789. But you knew about that, possibly. But did you know that as a result of September 11th, what happens if monies are being transported from one account out of the United States to another country? Well, that triggers now, as you see, a currency monetary instrumentation transportation report that exceeds $10,000 from one account out of an account that's being transported to another country, all as a result of September 11th. Turn the page. You start to see some of the regulations there associated with the Patriot Act, as I told you earlier, and that, of course, is the suspicious activity reports are known as SARs. This is all NASDAQ, ladies and gentlemen. It's all what you need to be responsible for. SARs are suspicious activity reports that now have to be filled out whenever we suspect suspicious activity. To give you an example of what suspicious activity might look like. Are you with me so far? Yes. There's the AML compliance programs that are mandatory, have to be filled out and implemented by the compliance director of your broker-dealer, that showing that they are educating us on how to detect suspicious trading activity in an account. And so that's a little bit about the, of course, Patriot Act designed to fight terrorism, all the byproduct of September 11th. Now we're responsible in our industry and also on NASDAQ. Now we move into the a sector of the economy, and we talk a little bit about some of that incentive that George Bush has established to revitalize domestic policy, and it is the byproduct of the George Bush economic boom package. Are you with me so far? Yes. And the first was at the top of the next page, Economic Growth and Tax Reconciliation Act of 2001, the gift and estate tax incentives. Now, look at me. Somebody dies. And when somebody dies, I want you to gather all of the assets and place a value on that estate. From real estate to cash to marketable securities to art, all of the assets, put all of the assets together of that estate and place a value on that estate. Now, the IRS comes in and implements what's called a federal estate tax liability on the value of the estate. Are you with me so far? Yes. George Bush has said we need to increase the exemption, the federal estate tax exemption on paying a federal estate tax liability on the value of the estate. And so what did he say in the year of 2006 to 2008? If the value of the estate does not exceed $2 million, no federal estate tax. So $2 million or less is the estate tax exemption. We go with 2009, look at it, 3.5 million. If the value of the estate does not exceed $3.5 million, there's no federal estate tax. See, above 3.5 million would be a federal estate tax liability that they would come in on a sliding scale and tax us federally. Are you with me so far? Yes. So we take a look at the increase of the exemption of the federal estate tax all the way from the years of 2002 to 2009. Take a look at what it says in 2010. The Act, the Federal Estate Tax Exemption Act, is repealed. Subject to the sunset provision, what does that mean? To 2011, the exemption returns to $1 million unless modified, which, by the way, is where it was in the years of 2002 and 2003. And what does all that mean? It means that this exemption only lasts up until the year of 2009. Then it's going to go back to where it was. You only get it for a certain period of time from the federal government. It doesn't last forever. Are you with me so far?
Yes.
Hey, there's our IRA contributions. Are you with me so far?
Yes.
There's our catch-up provisions. Again, as I've said, some regulations we've seen and some we haven't. Turn to the next page. There's the regulations associated with employer-sponsored plans. There's your regulations on KEO of 20% of pre-tax income of $40,000, whichever is less. Are you with me so far?
Yes.
And now I want to talk a little bit about educational IRAs and Section 529 plans. Are we all together on this?
Yes.
Are we all together on this?
No.
We're not? Okay. Don't be lost.
Right on point, and I turned it.
I'm on KEO. I'm moving from KEO into an area called Education IRAs. And then I'm going to Section 529 plans. Let's take a look at, and we'll make sure you have it, Education IRAs and KEO plan, and Section 529 plans. Listen to me carefully. Bush said, you know what we also have to do? We also have to establish some new savings investment vehicles. Not retirement plans, please listen to my language, but savings investment vehicles that are designed to allow people to put more money away to save money for educational expenses. Are you with me so far?
Yes.
Hence, the Education IRA and the Section 529 state-run savings plans. The Education IRA is also known as the Coverdell Education Savings Account. This is a savings vehicle that allows people to invest money on behalf of minor children for educational funding. The adult in this account is known as the custodian. Are you with me so far?
Yes.
Does not have to be related to the child. Are you with me so far?
Yes.
That's putting money into this plan or this account for educational costs. The maximum contribution is $2,000 per year, Series 7 Bullet 1. That money cannot be used as a deduction against earned income, Series 7 Bullet 2. But, please look at me, when the individual goes to pull money out of this plan, out of this Coverdell account, that money will be tax-free, Series 7, not taxed, if it's used exclusively for educational funding. Are you with me so far?
Yes.
The Section 529 plan is similar to the Coverdell IRA. Again, it's a savings vehicle that allows people to establish and put money into a plan for educational funding. Are you with me so far?
Yes.
Again, maximum contribution is $2,000. Can't write it off, but the amount of money is pulled out of the plan for educational costs that's tax-free. Now, then, therefore, what is the difference between the 529 plan and the Coverdell plan? 529 plan, unlike the Coverdell plan, 7 is a state-run plan. State of Maryland, state of New York, state of California all have different bylaws. So when a client calls up and says, you know what I think we should be doing, my financial advisor, let's establish some type of state-run 529 for my children. He wants to start putting money away for the funding for educational costs for his children, and so you want to send him the packet on the 529 plan for the state of New York or the state of California because one state's bylaws are different than another. Again, a savings vehicle that establishes an opportunity for clients to invest money to put away money for educational funding. Are you with me so far? Yes. SEC Regulation FD, it's called the Fair Disclosure Rule. What does that mean? This is a federal rule that says to the Merrill Lynch's and the Goldman Sachs of the world, Merrill Lynch, Goldman Sachs, if you are investing your own money proprietarily and you know information, and that information is publicly available, you must make that information known that you are acting in this capacity. If you fail to disclose to the general public through some type of medium like Dow or Reuters News what you're doing for your own investments, then you can be in violation of Regulation SEC FD. You fail to disclose to the investor public what you were doing for your own investments. They have a responsibility. If they take their own money and invest it proprietarily into securities and investments, they have to also let us know what they're doing. Are you with me so far? Yes. This industry is all about disclosure. It's called Fair Disclosure Rule. Fairly disclose, Merrill Lynch, to the investor public what you are doing for your own investments as well. Super Montage. That was something that we saw on night one, which was a system of electronic execution for NASDAQ small cap and NASDAQ large cap issues that executed one share shy of $1 million. Am I right?
Yes.
For OTC execution. Turn the page. We know that if you started to have a dialogue with me, and we started to talk about the European markets, and you started to talk to me about Deutschmarks, then you would certainly understand why I walked away from you. Am I right?
Yes.
Because it doesn't exist anymore. Because we no longer have Deutschmarks. What do we have? We have the euro. What is the euro? It is the unified currency of Europe. Are you with me so far?
Yes.
Why do they establish now one currency? To more freely flow goods and capitals, flowing goods and capitals in and out of the markets of the European markets. Are you with me so far?
Yes.
However, when we look at the euro, we ask the following question. What about London, Great Britain? What about the pound sterling? How come we have the pound sterling? How come London, England, does not have the euro? They're part of the, they're in Europe, am I right?
Yes.
Everybody else has the euro except for London, am I right? Except for England.
Yes.
So why does England have the pound sterling but everybody else in Europe have the euro? It's just a normal question. I was just wondering if you knew that. We don't know that. Well, there's something different about them? There is something different about them. They're not part of the European nations. Are you with me so far?
Yes.
Therefore, that's why they're not part of the euro. That's why we still have the pound sterling. I thought you should know something like that. Well, should I throw more darts against the wall and talk about the random walk theory known as the efficient market theory that randomly selects a portfolio from dart throwing that only relies on the performance of stock price gains and appreciation on the stock's price? Are you with me so far?
Yes.
No, I don't think we need to do that. We've seen the random walk theory, also known as the efficient market theory. Are you with me so far?
Yes.
But what you've never seen, that you're about to see now for the very first time, is the efficient market theory. No, that's the random walk theory, the modified portfolio theory of investments. And so we take a look at this document here that starts talking to you about the modified portfolio theory of investments. Are you with me so far?
Yes.
And we look at the next page where there's a chart and a curve. And it says at the top, constructing the optimum portfolio model. Are you with me so far?
Yes.
And then we go to the next page, which is even more dynamic, where we see the capital asset pricing model, which is the model that's used to price the modified portfolio theory of investments. And we read, and it's kind of a little bit difficult to make some semblance as to what this theory is really about. And so, if you'll allow me, excuse me, I have the real author of the real modified portfolio theory right here for you. And I want you to forget everything that you see right there in the body of that work concerning the modified portfolio theory, because all I want you to do is to listen to me, and I'm going to explain this theory to you in less than 4 minutes if you think you could just listen to me. Could you do that?
Yes.
Listen up. Your client that you have about $750,000 in assets under your management contacts you today and says he sold some investment vehicles. He also sold some fixed and tangible assets. And now he has established about $1 million of new capital that he wants to talk with you about and invest. But this particular million, he'd like to come on and see you today at 4 o'clock to discuss its investments. And so he comes down at 4 o'clock after the market closed. He's sitting here right now and he says, you see this $1 million that I have now? I don't want you to trade this money. I want you to manage it for me. Now we're talking about managed assets. The difference between the transactional business of brokerage, which is involving what? The solicitation, which is the cold-calling aspect of our business, and the issuance of a recommendation tied to the client's suitability and the capturing of assets and investing that money into securities and the trading of that money on the rising momentum, hopefully for appreciation, to show your client the gains of capital transactions for the commission business. That transactional business of buying and selling and trading client money is brokerage. Are you with me so far? It's a transactional business. Managed money, managed assets is completely different. Here's what he's telling you to do. I want you, my financial advisor, to design a portfolio for me that this $1 million would be invested in. You manage the $1 million in assets into a diversified portfolio, whether it's intermediate government bonds that pay a 6% yield, whether you take some of the $1 million invested into derivative trading activity, whether you take some of the $1 million and buy preferred stock, AAA rated bonds of the Treasury nature, whether you buy some commodities. Take the $1 million, invest it into a hybrid of a diversified portfolio. Maybe a certain percent of it's into large cap blue chip stocks. Maybe you keep, maybe $300,000 of the $1 million into cash for liquidity needs. Design a portfolio for me that this $1 million would be invested in. Manage the assets. Don't trade this money. So that By the end of the year, this portfolio that you have designed, where the $1 million is being managed and invested in, not traded, will pay me a guaranteed 6% or 7% yield on my investment, and you can protect my principal of the $1 million. This is called managed assets. What you're doing is you're diversifying the assets. The assets of the $1 million into a diversified portfolio. Some of these portfolios get quite involved and get quite exciting, depending upon the client's investment objectives. You can be doing arbitrage transactions. You can be engaging in spreads and straddles on index option contracts. You can be engaging in building a bond portfolio, diversifying some of the equity positions relative to the client's cash position, so that by the end of the year, that portfolio is going to generate a client return on his investment capital. This is managed money. And so when you get into the area as a financial advisor of trading client money with the marketplace, of course you'll start with the cold calling and the telemarketing to capture assets, capture clients, and trade that money for the transactional commission business that we've been working for more than 216 years. But you are bound to move into seeking and speaking with accredited clients, where they're going to want to go into a little bit more of the managed portfolio of managed assets and go into the strategies of asset allocation trading techniques. So what is the allocation of the assets? You're taking a percentage of the $1 million and diversifying it. Take a look at that chart where it said constructing the optimum portfolio model. Just as an example, one more time, where you see it at the top where it says constructing the optimum portfolio model, I think you see in the last sentence of that first paragraph, they talk about asset allocation. Maybe taking 60% of the $1 million invested in stocks, but they don't say what stocks. We get very specific as to what particular equities, what class. Are they preferred? Do they pay cash dividends? Are they speculative stocks, large cap, blue chip issues, internet issues? 30% of it maybe of the million, put it into bonds. What bonds? Are they intermediate government bonds? Are they treasuries? Are they agency securities? Are you with me so far? And then 10% of it in cash. Or maybe they'll go into the last sentence there. Take a look at that. 20% stocks. What stocks? 20% bonds. What bonds? And 60% cash. The diversification by percentages of the assets of the $1 million invested into a hybrid of a portfolio of managing money is called asset allocation strategies and techniques when you're dealing with more sophisticated clients who want you to go into managed assets. And don't worry about placing a valuation on a portfolio through the capital asset pricing model, not on NASDAQ. Are you with me so far? Just be aware that the modified portfolio theory of asset allocation trading strategies takes percentages of the portfolio's assets and diversifies it into among multiple different product and investment vehicles to go into what is called managed assets for a managed portfolio. Are you with me so far? And now, in summation of today, we start to move into some wonderful charts and graphs. Are you with me so far? Yes. And I want you to turn all the way to the relative back, where you'll see a page that says, if you look at me, useful charts. Yes. Keep turning. You'll get there. I know you will. We take a look at the first chart. Again, some of the charts and graphs we've seen, some we have not yet, and some we will see in the coming week. There we talk a little bit about the underwriting process, different types of IPOs and firm commitment, all the non-best efforts, mini-maxi. Are you with me so far? The bottom of the page starts to talk about the equity IPO timeline for stock underwritings, all the way from the preparation of the registration statement, all the way through to the filing of the registration statement, and then column middle, the blue sky, the 20-day cooling off period, the issuance of the due diligence meeting, and of course the exceptions of the indications of interest of the red herrings, the effective date, which is the date that was signed by the SEC, which is the date the security goes public on stocks, and then of course sending out the final prospectus to any client within 1 business day of a client's request who might want to buy into the IPO, 25 days from the date it goes public, or the effective date for companies that are going to be listed on NASDAQ or a major exchange. Are you with me so far? Yes. Next page talks about the restricted period of time on 144, which you know is 6 months. Are you with me so far? On private placement stock. The similarities between rights versus warrants. Warrants, the ability to exercise or exchange those warrants into the common that the warrants are attached to at subscription. Rights offerings process, the opportunity for the client to take rights, buy more new shares of stock at subscription, which hopefully will be cheaper than the market price of those new shares when they go for sale 6 weeks or 6 months from today, to allow common stockholders to maintain their equity ownership of the company they have a position in. The characteristics and the features between common and preferred, which we should know by now. There's a flow chart on secured bonds and pass-through certificates you'll see next week. The latter part of this week, I should say, when we finish and complete out the bond area. The regulations associated with characteristics of GO and revenue bonds, we'll sum that up by Thursday night. the area that says disregard Chapter 13 features and the characteristics that we saw last week associated with open-ended mutual fund shares versus closed-ended shares that I thought in summation would be great. And at the back of the page on the left, qualified retirement plans that have been offered by the employer to the employer that have met, conform to ERISA versus wide right plans that have been offered on a retirement basis by the employer to the employees that have not conformed to ERISA. 7. That's the end of today, and today was a lot of regulation. And now, your curriculum going forward to get ready for Wednesday and Thursday on the bonds. You have in front of you the addendum to be read tonight again, cover to cover, along with a document in my publication called Annuities, which you will read tonight as well. Step 1, let's have a newfound reading in 19 and 17. Are you with me so far? Yes. Step 2, the notes. Step 3, the addendum. And step 4, my publication on annuities, which was considerable. I want to dedicate just to tonight because these percentages and regulations were very significant in volume for NASDAQ. Are you with me? Yes. Tomorrow, the reading is significant. We start out with a reading of 5, 8, and 10. By the way, is a lesson for Wednesday. Also, after the reading of 5, 8, and 10 tomorrow, I then want another reading tomorrow night of 10, 12, and 7. And then tomorrow night, a second reading again of 5, 8, and 10. Extensive reading, and bring 5, 8, and 10 with you on Wednesday at 11:15. Wednesday, 5 bond fundamentals, 8 bond types on the municipal bond side of going revenue, 10 on the underwriting process for municipal offerings, and then, of course, on Thursday in the graduation on the bond side, we continue with the secondary market trading of municipal bonds, which is Chapter 12, bringing your final SRO and MSRB, which is the SRO that will regulate the municipal bond markets. And so the first segment of Thursday is all municipal bonds. Second segment on Thursday in 10, the primary market for the Treasury auction market on Treasury bills, notes, bonds, strips, and tips. Fannie Mae, Ginnie Mae, Freddie Mac, and Sallie Mae, and go into the characteristics in the second segment on Thursday for the features associated with Treasury and agency securities. And then, of course, get ready for Phase 2, Phase 3 on the crash, and then, of course, graduate you out of this program. And then one final session again on the options, only because I want those regulations brought in, only for the ongoing people. Thursday's last day for crash. Monday's the last day for the ongoing people. The bonds are coming. And believe me, you're going to thank me so much that you have tomorrow as a break to get ready for them, because I'm going after 125 questions minimum, maximum 140 on NASDAQ, and you need a day just to get that reading under your belt to get ready for those regulations. So, this is week 3. Let's see what we can do about it. I'll see you on Wednesday. Come on. Thank you.